Howdy, ladies and gentlemen. It's time for another exciting episode of Stacking Adventures. Today's Saturday, January 2nd, 2021. And this is the first episode of the fifth season. So season 5, episode 1 of Stacking Adventures. And the first show of 2021. So let's get started. So I got all the gold and silver here. Of course, it's not real silver, it's just clad coins. And this isn't real gold. But it's good for an illustration. Because 2020 turns out was a great year for owning gold and silver. So if you went into 2020 with a stack of silver coins and gold coins, you actually did pretty well, as we're going to see. So just let's take a look at the numbers. So today we're going to cover the asset returns for 2020. So we'll just jump right into it. And first thing I want to do is just look at the very top level. What was the return for world stocks, bonds, gold, and cash? And they're all listed there. And by the way, what I'm going to do is look at the return from some funds. And the reason I'm using funds is because funds are things that people can actually invest in. In fact, millions of people do invest in them. So I don't want to just look at some theoretical numbers like an index, theoretical index or something. We're going to look at an actual fund that people invest in. And we're going to look at specifically Vanguard mutual funds because they're the lower cost ones. And literally tens of millions of people invest in these Vanguard funds, and they will have gotten the exact return you see here. So first of all, on the very top there, the total world stock index. So this is all the stocks in the world that they can invest in. And had a return of 16.69%. So that's pretty good. Anytime you get double-digit returns, you're doing pretty good. But in the next line right below that is gold. I'm actually using the gold ETF, GLD, which is the Spider shares. And that actually returned almost 25% last year, 24.81%. So that was actually the winner as far as the major asset categories go. And then we got the bonds. The U.S. bond market returned 7.72%. The international bond market was a little bit worse, 4.5%. And if you just had your money in cash in a money market fund, you got about 0.5% interest. So gold was the big winner there. So let's take a look at some of the other metals and see how they did. So there's the precious metals, and also I have copper in there. So it turns out that on the second line there, even better than gold was silver. Silver did even better than gold last year. And you can see there's all that silver. And we sold some silver this year. And we actually did pretty well doing that. So silver was up 47%, almost 50%. Gold was up almost 25%. So silver did about almost twice as good as gold. And it turns out palladium came in pretty good also, about 25%. In fact, it slightly edged out gold. And platinum was only up about 11% or so. Now, a big surprise was if you held copper coins or any kind of physical copper or copper wire or anything, copper tubing, it was up almost 25% last year. So your copper memorial cents and your wheat cents and Indian head cents all went up almost 25% last year. So let's look at some more of the stock and bonds, because most people invest in stocks and bonds. So here I'm just comparing you remember I said the whole world went up about 16% for stocks. So I'm comparing here the U.S. stocks versus international stocks. And on the very first line, I just have the S&P 500. That's like a very common thing that people like to quote all the time, even if they don't invest in it. That was up about 18% last year. But the total U.S. stock market was up almost 21%. So that's a little more representative, and it actually did a little bit better. Meanwhile, the total international stock market did okay. It was up 11%. But that's, like I said, double digits is fine, but the U.S. stock market did like twice as good as the international stock market. Well, let's just dig a little deeper into the U.S. stock market here. So here we got the big breakdown often is between value stocks and growth stocks, and large stocks and small stocks. So the first two lines shows value and growth, and you can see that the growth really did really well compared to value. The growth stocks are up almost 40%, whereas the value stocks are up only about 2%. And by the way, you notice I've broken down the total return into the capital return, which is a return from a price increase, and the income return, which is a return from either dividends or interest. And you can see that whereas the growth stocks don't pay much of a dividend, only 1%, whereas the value stocks paid about 3%, the growth stocks grew almost 40% last year. So they got a total return of 40%, whereas the value stocks actually got cheaper last year. Now, does this mean you should be buying growth stocks this year? Who knows? But all I can tell you is that the value stocks actually got a little bit cheaper. So there might be a little more of a bargain now. The last two lines compare the large cap stocks and small cap stocks. And you can see that the large caps, and they did about the same. The large cap did just only a little bit better. Okay, now let's look at dig a little deeper into the international stocks. So the big breakdown between international, between the developed market and emerging market, and between the regions, Europe and Pacific. So developed markets, what those are is all like the first world countries like the United States and Canada and Great Britain, Germany, Western Europe, Japan, all these developed economies. And emerging markets are smaller economies, typically like Eastern Europe or Southeast Asia, places like that, maybe India. Yeah, I think even China is an emerging market. It's a developing country. And you can see that the emerging markets actually did better than the developed markets. It was 15% for the emerging versus 10% for the developed markets. But they both did pretty well. Like I said, as long as they're in double digits, no one should complain. Now, if you break it down between the Europe and Pacific, Pacific did much better, 16% for Europe, for Pacific versus only 6% for Europe. And I'll tell you that Pacific, it's mostly Japan. So Japan must have done pretty well this year, although it's been doing pretty poorly in previous years. So maybe it's just making up for it. But yeah, so Pacific definitely did well this year compared to Europe. So let's move on and let's now look at some people, like to invest in dividend stocks. It's a very popular way of investing. So I compared here, there's two different strategies. Some people invest in high dividend stocks, and other people invest in stocks that don't pay as much, but they grow. They have high dividend growth. And it turned out last year, in both the U.S. and the international markets, I show all of those here, the dividend growth, which is called the dividend appreciation indexes, is the U.S. and international, both went up about 15%, whereas the high dividend stocks, both the U.S. and the international, didn't do so well. The U.S. was only up 1% altogether. Even though it yielded 3%, the price actually fell by 2 or 3%. And the international ones, even though they yielded almost 4%, they fell by over 4%. So they actually had a negative return in 2020. I think that's the first one we saw here with a negative return, minus 0.7%. So again, does that mean you should be buying the appreciation this year? Nobody knows. But certainly the things that went up in the price are less of a bargain they were at the end of last year. And the things that went down were a little more of a bargain. Okay, let's move on here. Next, I just want to look at some sectors. And this is where things really, the wheels fell off everything here. These are real estate, energy, and healthcare. And it turns out both U.S. and international real estate did awful. While the U.S., these are called REITs, real estate investment trusts. And while the U.S. they have a pretty good return, almost 4% return, they fell by over 8%. So the total return was like minus 4.6% for the U.S. And for the international, it was even worse, minus almost 7%. So you would be pretty sad if you had a lot of money in real estate last year. And the energy fund was the absolute worst of all, I think. Had a return, total return was minus 31% about. So you lost 30% of your money, and most of that's because the price of it went down. I suppose they must own like a lot of energy funds, energy companies like ExxonMobil. I haven't looked at individual stocks, but they must have gone down in price. I did not know that until I started looking at this. So yeah, those are the big losers if you had a lot of money in the energy sector. Now the healthcare sector actually didn't do too bad. It was up 12.6% for the year. I think now we're going to turn our attention to the bond market or fixed income. And we're looking at the stocks here. That's basically equity or ownership. Now we're looking at the bond market, where it's basically you're lending money to somebody, either government or a company or somebody. So this first chart shows it's basically the safest, the lowest risk bonds that are out there, and it's lending money to U.S. Treasury or agencies. And I show here, starting off with the money market fund, and those actually aren't treasuries, but that's what I included here. And if you had money in the money market fund, it's like having cash. You basically made about 0.5% last year, so not a lot of interest. And then I show short-term, intermediate term, and long-term bonds, and they pay their interest was about under 1% for the short term, about 1.6% for the intermediate, and 2% for the long term. So not a lot of interest earned last year. However, the interest rates actually went down even further, so the prices actually went up. So the short term gained 3% in price, intermediate 6%, and the long term gained almost 16% in price. So their returns were 3, 7, and 17%. The next to last line shows the TIPS fund. TIPS stands for Treasury Inflation Protected Securities. Basically inflation bonds issued by the government. And again, they don't return a whole lot as far as yield goes, 1.4%, but they went up almost 10% in price. So you got 10.9% out of that. And finally, I showed one of the agencies. It's the Ginnie Mae Fund. That's the Government National Mortgage Association. I wanted to include this because that's basically kind of reflects a little bit the mortgage market. And it yielded about 2%. That's what you get for income return. But the price, just barely went up almost 2%. So you get about 3.8% return from that. So, and then the next fixed income market we're going to look at, we'll look at the tax-exempt municipal bonds. Now, if you're a wealthy person, a lot of wealthy people have to pay a lot of taxes. So what they do is they put a lot of their money to municipal bonds. And these are issued typically by state governments and local governments. And it's to pay for things they want to build, like maybe a water system or a sewer system. And they have these municipal bonds, and you don't pay taxes on them. So, well, how do they do it? They're kind of like treasuries, but they typically pay a little bit more because they're slightly riskier than treasuries. Well, let's see. The money market municipal fund paid 0.5%, same as the prime money market fund. The short, intermediate, and long term, you got 1, 5, and 6% out of those. It's not great, but it's better than losing money. And then there's another category called high yield tax exempt. These are bonds that maybe have a little worse credit rating, and they pay a little bit more. And you actually got about 5% return out of that. You can see where the income return on the high yield tax exempt is a little bit higher than the other ones, even higher than the long term ones. Okay, so the next fixed income we'll look at is the corporate bonds. And the corporate bonds usually have a higher coupon on it than the treasuries because there's some credit risk, right? A corporation could go bankrupt and not pay off its bonds. So I have short, intermediate, and long term, and they made 5, 9, and 13 respectively last year, even though they're only paying about 2 or 3% in yield. And then there's a high yield corporate bond fund, and this people call them high yield bonds. They call them junk bonds. They call them low grade bonds. They're basically riskier companies. These aren't your IBMs or anything like that. These are more of like second tier companies that are a little riskier. You notice they have a higher income return, almost 5% yield, but they hardly went up in value. They about broke even. So you made about 5% last year. Okay, the next one I want to look at is, that was stocks and that was bonds. So let's take a look at, there are funds that invest in both stocks and bonds. And they'll typically come up with some mix of 60% bonds, 40% stocks, something like that. And this is closer to what people will get when they invest because typically people don't put everything in stocks or bonds. So a good example here is the balanced index. It's 60-40 stocks and bonds. It paid about 2% yield, but the price of the fund went up about 14%, so you made 16% overall. So not bad if you're 60-40. And another one is Target Retirement, which is looks like it's actually 70-30, and that one yielded about, it's almost the same, about 2% yield, but it only went up about 8%, so I made about 10%. A couple of very popular ones here is Wellesley Income and Wellington. A lot of retired people have Wellesley Income. It's got a 40-60 mix of stocks to bonds. And last year, well, you got from your income, from the yield, you got about 3%, and the price went about 5%. So you made about 8%. Wellington had more stocks in it, and so it is also at about 3% yield, about 2.5% yield, and but it went up about 8%. So a little bit better than Wellington, was a little better than Wellesley. So you can see a lot of times when the stock market does well and the bond market does so-so, the more you have in stocks, the better you'll do, obviously. So the mix, when you have a higher mix. But on some year when the stock market goes down, you might see losses in the place that we have a lot of stocks. And the other one I mentioned there's also a global Wellesley now and a global Wellington. So these invest in the international also. And they did slightly worse than the U.S. only Wellesley and Wellington, which makes sense because U.S. stocks did better than the international stocks. So the last thing I'll look at is we'll go over here to this sheet here. Is most people don't invest in just one ETF or one fund or something. And they have what they call as portfolios, where it's like a mixture of funds. And so what happens is there's various, financial writers, people write books, they write magazine articles and stuff like that. And they're, so-called experts. And they'll give you some advice on what to invest in, which ETFs. And typically they just tell you, here, invest in this handful of ETFs and, put 20% in this one and 30% in that one, and then just keep it that way. And maybe once a year you rebalance back to get the same mix. So I just listed a few here to just see how they did. The first one was Andrew Tobias. And he has a really simple one. He's got these ETFs he chose as VTI, EFA, and SHY. And it's just basically just 3 ETFs. And ends up being has the third column, I show you how much in stocks, bonds, commodities, and cash. And, by the way, gold will be considered a commodity by these guys. He's got about 2/3 in stocks and 1/3 in bonds. And he made about 10.5%. Another famous writer is this guy, Bill Bernstein. And he has what's called the Coffeehouse Portfolio. And it's a lot more complicated. It's got 10 ETFs in it. But it's still about 60-40 stocks to bonds and no commodities or cash. And he made about 12% last year. Another guy wrote a book called The Coffeehouse Portfolio. This is probably about 20 years ago I wrote this book. He's got a portfolio he recommends with about 7 different ETFs in it. He's also 60-40. He made about 7.5% last year. There's this thing called Boglehead's 3-fund portfolio. It's pretty simple. It's got a U.S. stock fund, a foreign stock fund, and a U.S. total bond fund. It's kind of stock heavy. It's got 80-20. But since stocks did well last year, it did well last year. He made 15.4%. Another guy, David Swenson, is a very famous fund manager. He used to manage the Yale Endowment. So they have a portfolio called the Yale Endowment Portfolio. It's not actually what Yale invests in, but that's what they call it. And he's got about 6 different funds in it, 70-30 stocks, bonds. He made about 12%. The next one there is another fund. This isn't Vanguard. This is Dimensional Fund Advisors. It's a famous fund company. And they have a portfolio with 6 of their funds in it. It's about 20% stocks and 80% bonds. And they made about 8.7% last year. And just a few more of those we'll look at. There's Larry Squadro. He's written many books on investing. He's a money manager and he manages people's portfolios. And he has one called the Larry Portfolio. It's got like 4 different ETFs in it. It's 30-70, 30% stocks, 70% bonds. And he made about 6.5% last year. Another guy, Mebane Faber, he has something called the Ivy Portfolio. It's got 5 ETFs in it. And this guy actually has some commodities in it. So he's 60% stocks, 20% bonds, and 20% commodities. But it really backfired on him. For some reason, I think it must have been the commodity exposure. He must have been exposed to like oil or something. He only made 2.25% total return last year. And by the way, he was like, of all, maybe like a few dozen, these lazy portfolios, he was like the next to last. So another guy, Scott Burns' couch potato portfolio. This is an interesting one. Only has 2 ETFs in it. VTI, which is like, I think the U.S., it's either the U.S. or the world. I forget which one it is. And he's got a tips fund in it, 50-50. And he made almost 16% last year. So, his sometimes really simple is the way to go. The next one here, they call it the Warren Buffett portfolio. And I don't believe it's actually what Warren Buffett invests in, but they call it that because it's like his style of investing. And it's got only 2 ETFs in it, VV and SHY. And I believe VV is the large cap stock index, and SHY is like short-term treasuries. He's 90% stocks, 10% short-term treasuries, and he made 19% last year. That was one of the best performers of all, because the large cap stocks did really, really good. Because I think I could show that. Did I show that before? Yeah, if I go back to here. Nope, that ain't it. Is that it? Nope. Here it is. Yeah, see, the large cap stock and it went up 21% last year. So he was 90% and that thing that went up 21%. So yeah, he basically did really well. And the next one I included because it was actually the worst one, the aggressive global income. It's got 4 funds in it. I'm not sure what they are exactly, but he's 80% stock, 20% bonds. And I think he was all over the world. And they just basically, there was one of the few that lost. Was it maybe the only lazy portfolio that lost money? Minus 1% about, not too good. And finally, I included this last one here is the Harry Brown portfolio, which a lot of people who are stackers might be interested in, because it's one portfolio. He has 4 different funds in it, and he has a stock. There's 25% in each one. He's got 25% in stocks, 25% in long-term bonds, 25% in gold, and he's got 25% in cash, basically. And that actually did 60% this year. So, not too shabby for the Harry Brown portfolio. And Harry Brown, if you don't know him, you might want to look him up because he was a very famous gold bug. He recommended investing in gold back in the 70s, and he basically made millions doing that. So anyway, that's the report. That's our 2020 asset returns. And hopefully we have a good 2021.